everyone. This is Paige Garvin from Jennifer Shouts and Associates. We are coming to you live from Washington, D.C. today. Thank you for joining us in a sponsored content webinar. Our webinar is brought to you today by Alent Capital. Before we get started, I'd like to remind everyone that the webinar is being recorded and that the recording will be sent out within 24 hours. You can also find our 800 plus government contracting videos on our YouTube channel. They are all complimentary. And lastly, please post any questions in the question box in your control panel and not in the chat box. Today's session is Best Financial Practices for Emerging Federal Contractors. We'll look at why an awarded contract doesn't mean available cash, walking through a real $10 million example of the gap created by retainage and billing lag. Then cover practical tools, a method for forecasting cash exposure, and a simple way to track delivery, billing, and payment, a standard post-award checklist, and how to match the right capital to the right need. We'll close with a readiness check so you know where you stand before chasing bigger awards. I'm joined today by Josh Leffler and Eric Rabinovich. Over to you, Josh.
Hey, everybody. I'm Josh Leffler. It's a pleasure to be here. Thank you for having me. I'm the Chief Product and Technology Officer at Alent Capital, and I'm joined here by Eric Rabinovich.
Yeah, thanks, Josh. Hey, everyone. Appreciate you taking the time to join us today. And before we get into the topic of today's webinar, which is around best practices for financing, if you're thinking about applying for financing or seeking financing in the government contracting or federal marketplace, we're going to talk about what we believe are best practices for firms to think about. But before we get into that, just a little bit of information on Alent Capital, Excalibur GovCon Capital, and myself. So Charlie, who's the CEO of Alent, he's not on today, but he often shares a story about how growing up, his father, if I'm not mistaken, I believe, Josh, correct me if I'm wrong, they ran a, was it a hardware store?
An auto parts store.
Yeah. Auto parts store. But the long and short of it is cash flow was a constant stress point for his parents, his father, the family, and it sort of spurred him to try to help solve that problem. And I won't do his story justice, but what I will say is Alent Capital is partnered with Excalibur GovCon Capital to provide working capital solutions for small businesses in the federal marketplace. And so we offer a revolving line of credit, which we think is a great option, a great tool to address some of the working capital pain points that we will touch on and we'll unpack in some more detail in today's webinar. And we've talked a lot about this in some of our previous series sessions from earlier discussions. So I encourage everyone, if you have not watched or listened to some of those webinars, definitely go back and look over the last month or so. We've put a number of sessions out there that we think have a lot of additional context that might be valuable for folks in the space. So with that being said, myself, just quick introduction. I'm managing director at Excalibur GovCon Capital. Previously worked as a vice president at Live Oak Bank, where Josh and I actually worked together and helped stand up their government contracting team. Prior to that, I was a contracting officer for the Food and Drug Administration as part of Department of Health and Human Services. And so lastly, Josh and I also worked before that together at PricewaterhouseCoopers in their public sector practice, which is now Guidehouse. So we've been on different seats at the table, in different seats at the table as contractors. I've been on the other side as a contracting officer and also on the side of a lender, helping small businesses in the space grow and access capital in a sustainable manner. So that's a little bit about us. The point of today's discussion is to talk about what, as a potential applicant, what are best practices? So if you're in the space, if you're just getting started, or if you're running into cash flow constraints and you're thinking about how can I get approved for a loan? If you need, to solve some of the issues we'll be talking about today, what are some of the best practices to keep in mind? How do you prepare and position yourself to maximize the probability that a lender is going to say yes, whether that's document hygiene, other steps as far as getting prepared, having your financials in order, your books in order, and so forth. So with that being said, let's get into it. Can we go to the next slide? Okay, so one of the things we always want to emphasize is how there's a really critical distinction between what value you've been awarded versus what you're going to actually have available in terms of funding. And there's many different distinctions that I think need to be made within that, ranging from the difference between a vehicle ceiling versus the total potential value of a funded task order. Um, that's namely a distinction between, what you could potentially be awarded over the course of an entire contract if all of the option periods are exercised versus if, we're just looking at the base period. So the main point is, just because you won a $10 million contract, without more context, it's not clear what that means, right? That's not clear if that's the base period, if that's just the total ceiling value. And so that's really important, because that will, of course, drive a number of things, not least of which is how much capital you actually need, but also what's the likely value of the award that you'll be receiving, assuming performance is successful, option periods are picked up. So these are really important distinctions that especially newcomers to the industry, they need to understand before they talk to a lender or apply for financing. And I can't stress enough how often we'll get told, we need X amount of dollars, and maybe it's typically a newer small business who's new to the government contracting or federal marketplace, but they'll say, they need a lot more than they realized without really understanding some of these nuances and the distinctions, and also the timing. You might actually win $10 million over the course of 5 years if it's $2 million per year. But the timing of that is, of course, very different. That's not all being awarded at once. The costs aren't all going to be realized all at once as well. So these might sound pedantic or pretty elementary, but it is an important distinction to be made, because it really sets the stage for the conversation about how much financing you need, and understanding, what that cost structure is, so that you can give accurate information and know what you're asking for when you start engaging with lenders. And that's to say nothing of the timing lag as well, right? So that's the core pain that we are serving to fix. We're helping small businesses address. That core pain I'm talking about is when you've been awarded a contract, you have not been able to invoice or get paid yet, but you have costs you have to cover in the immediate, in short term, immediate future. So whether that's staffing, paying subcontractors, paying for software licenses, in some cases paying for physical product and suppliers who might not be extending terms and financing or payment terms to you, right? These are all things you need to understand that tie into that gap that our product at Alent Capital and Excalibur GovCon Capital serves to fix and alleviate. Anything you want to add on this slide, Josh?
No, I think you covered it perfectly.
Okay. Okay, great. All right, let's go to the next slide. So I think that the the first thing I want to state on this, obviously, there'll be consistent themes we'll be stressing throughout the course of this webinar, but the four steps you see here, they produce one number, and that is the whole point. It's not really four exercises. Obviously, you could view it that way. I think another way to think about it is it's really one output you're striving towards that you can then act on. So I think when we talk about triggers, these are all generally, these are known dates. Nothing on here should be a surprise. So you know when the contract performance starts if you've been awarded. You know what your payroll cadence is and how often you're going to have to pay your employees that you have to hire or re-vector to this particular contract or multiple contracts. There are things like material lead times, obviously bonding. These are all known factors. And so if you can put them on a calendar, you can put them in a forecast. And I think that's the critical starting point here, because it's all of these are going to lead into the next step, right? So once you have that, depending on what your various cost variables are, it should allow you to start building to the long end of the range, so 90 days. Your first invoice usually isn't necessarily at day 30. It's usually after a full billing cycle closes. You have to reconcile costs to CLIN items. There could be, acceptance steps on the part of the government. So you might generate the invoice at day 30, but it's not a 30-day cycle you're solving for, because there's a whole host of additional steps that have to take place, typically, for an invoice to then be approved, processed, and ultimately paid. And on average, we can see that range from anywhere from 60 to 90 days. I know there's exceptions to that, and if that's the case, that's great. I think the sooner a vendor gets paid for the work they're performing, the better. But a lot of what we're sharing today is just based off our actual lived experience and our observations being in the marketplace for the last 15 years. All right, next step would be getting an idea of the amount, and knowing the timing gap will help dictate that next step in terms of what amount it is, right? If you're only planning or solving for 2 payroll cycles versus 4 payroll cycles, those are going to be very different amounts. Assuming a constant staffing level, that's really important to understand. But again, to my point earlier, these all stack on top of one another. And so if you have a good idea of what that actual gap is going to be, maybe you've worked with that customer before, that department or agency, you know how fast it is for them to pay contract or invoices that you submit. Maybe you have relationships with other vendors who are with that particular customer, but anything you can use to your advantage to have an informed posture around what the actual timing gap is. Usually, if you just go to the contracting officer or the core and ask, if it's your first time working with them, how long is it going to take you to pay? I don't know how accurate or how reliable they might be. I think they'll probably give you some canned answer or, refer to agency policies, but, you want to know the actual practical number from other vendors, or, again, if you've worked with them, to help plan for what type of gap you're going to be looking at with the particular contract. And then lastly, whatever existing liquidity you have is going to play a role here. So just because you have the number calculated based off steps 1 through 3 doesn't mean that that's the need. Of course, if you have other contracts, if you have cash in the bank, that's all going to play a factor here in terms of what your need may be here. So so that could help a little bit, right? If you have some existing liquidity or other contracts where perhaps there's a a better payment cycle, or you're not out in front of your skis, so to speak, as much. That could help offset whatever the need is. And so that's the last piece here. Well, I love to give an example here. We actually worked with a services contractor who modeled about 600,000 of exposure for a mobilization based off payroll and paying subcontractors. And the actual cash out before that first payment came in was closer to around 850,000. So it was actually much greater than what they had thought. And the delta was really, it came down to primarily fringe, taxes, and overhead that kept running. And none of that was in the model. And so the contract you win could have impacts on some of those ancillary cost variables. So in that case, we did, during the course of underwriting, flag this and walk through it with the client, but they weren't wrong about the direct costs. They just didn't count everything that leaves the account, and so they didn't have their arms around that actual need. So yeah, that's hopefully that's straightforward. I mean, if there's questions or folks want to talk about their specific circumstances, as we've said on previous calls, we would love to have a conversation with anyone. Please reach out. We're happy to talk about your specific situation and circumstances. The last point I want to make on this slide before we go to the next one is that this is essentially what we do when we size a facility, what I just walked through. So, how much unbilled obligated work is left, and really trying to understand if there's enough runway behind the debt to be able to cover what the ask is. So a contractor who walks in with all of this already calculated and that preparation completed, as you might expect, really sets you apart and puts you in a much better position. It allows us to give a fast response. We love to give fast yeses, but we also think it's important to give folks a fast no as well, if it's not a good fit for whatever the reasons might be. But that's important for us as well, so that you have your options and have enough time to evaluate whatever other options you have if we aren't necessarily a good fit for someone. So yeah, needless to say, it makes it a lot easier to underwrite, allows us to give you a much faster and better answer. And we're basically validating your number instead of deriving it, which is where you want to be. That's much better from our standpoint. All right, next slide, please. So we're going to talk a little bit about what we think is a fairly low bar. I mean, this can just be a spreadsheet, 6 columns. Do you need a system for this? In an ideal world, yes, but you don't necessarily need something sophisticated to be able to track what you see here. And what I mean by that is, the hard part isn't having a system, it's the discipline to have accurate data and being able to know what the answers are to each of these that you see here. So I'd say the thing you see here that's the most critical and the column that matters most, it's the status. And the discipline is basically tracking every invoice to paid. So if you've sent something, that's an activity. Paid is a fact, right? If an invoice has been paid, there's plenty of contractors out there who believe they're current because everything has been submitted, but they discover 3 invoices may have been rejected weeks ago. So really having a system in place or having a process in place where you know what the true status is of an invoice, there's a lot of ways that can actually take shape, but it's what allows you to A, get paid faster, but B, allow, if we're getting pulled in and you're applying for financing, really knowing what's been billed and what the status is, that has a direct impact on what sort of availability you're going to have with us in the way that our product works. We are essentially lending against unbilled obligated dollars. And so the status of invoices is really critical, and being able to track that status and the relationship between deliverables and acceptance. Those are all really critical factors that can either include certain dollars on that contract from being part of line availability or exclude it. So really important piece to emphasize here. I would also add, just by way of example, a contractor's backlog schedule that we've worked with recently. They showed a contract with approximately just under 550,000 left to bill, and the period of performance actually had ended a few months earlier, and only it was just about 15,000 had ever actually been billed against it. And that wasn't something that someone flagged for us. And it was not clear in that case if they just didn't bill the work and the contract was going to have those funds deobligated as part of closing out the contract. If that work, maybe there was a modification that hadn't been submitted or disclosed to us. So it's an example of what we're trying to drive home with this slide in terms of just really understanding the statuses of those dollars for each contract, and then any invoices tied to that. Some of this isn't obvious without context, and so we really want folks to walk away knowing when we're talking with them, what is the status? What is if a contract has a bunch of money that's ostensibly been left on the table, what's the story there, so that we can know that might be perfectly excuse me, it might be perfectly legitimate receivables, and it might be value that just will never be realized, but that's not something we would know without that context. All right, I think that's it for this slide. We can go to the next one. Okay, so these are what we think are best practices around how contractors should react to every award they make, and in terms of having a repeatable, scalable system in place. The main idea here is that the fewer decisions that you have to make over and over from scratch after every award, I think that's only going to help. So every award where you run through those same 5 steps, and if you're calmer and more if you're more experienced and have basically you're operating off muscle memory, that's going to reduce the overall chaos and just lack of organization that you might otherwise be dealing with if you're flying by the seat of your pants, so to speak. So the chaos on the award number 4 here, you see, it means nobody is going to write that down. And my point is simply, the more times you go through something and have a documented and repeatable process, the more likely the next time you go through it, you're not going to run into the issues as much. And so this is what we've seen work for other vendors in the space. I think that if you don't load the contract with cost codes in week 1, you're not going to produce a job cost report later in the process. So a single report, and I say this as a lender, a single report is ideally what we're going to want to make decisions off of. So being able to consolidate this data and have it ready-made and available off the shelf, it's going to make our jobs easier as lenders in terms of being able to look at the data, be able to drill into a specific cost on a specific like AR report for a certain contract. Having these processes in place allows that reporting to happen that much more smoothly, and then allows us to be able to underwrite and service our customers a lot more readily and with less handholding. One example I'll offer here is that one of the observations we have in the time we've been doing this, one observation that I have is we have, for modifications on contracts, we see that they aren't necessarily logged in one place. And so there have been instances where we've reconciled the contract backlog and have seen periods of performance that had passed, and similar to what I talked about on the previous slide, but the extensions were there and they hadn't been loaded into SAM yet. And these were Department of Defense contracts. As some folks may already know, there's often a lag when an actual contract action is completed and when it's reported in SAM, or what was formerly FPDS. That's really important, because if we think a contract might be expired and the unobligated or the unbilled obligated dollars are at risk of not being realized, if we don't know that there's been that modification, then obviously that's going to have implications around what the line availability is. So this is something where we really stress, keep your modifications as one and the same with your contract backlog, and store everything in one place. That is going to allow us as a lender to be able to monitor that and see that very easily if there is that disconnect with the dates, and specifically a contract that appears to be expired. We do our best to validate everything using FPDS or what's now SAM.gov, but not everything is in there in real time. And so for contractors to be able to anticipate that, get in front of it, and then report on that accurately, it's really helpful. And it also shows that you're prepared, which of course helps us in terms of making the argument to our credit committee and showing that you're a responsible and capable contractor. It sets everyone up for success. Okay, that's it I wanted to cover for this one. Let's go to the next slide. Okay, so we've talked a bit about this in some of our previous sessions from our previous previous webinars, but what we want to stress here is that the most important piece of determining what your actual need is understanding the different buckets and categories that those needs map to. And I talked about the contractor in a previous example about missing some of the indirect and fringe costs and employee taxes, overhead costs. It's a similar point here. The needs and the nuances of having to cover payroll versus materials and vendors, or just having a invoice that is delayed in terms of processing, or maybe acceptance got botched somehow and now the clock has reset. Each of these different scenarios will have different implications in terms of what the capital need is, whether it's recurring, whether it's one-off, whether there's additional documentation that may be requested. In other words, we're going to ask for different backup documentation when a client is requesting a draw for payroll versus when they're requesting a draw for material costs or vendors that they're working with for certain physical goods or software licenses, intangible goods as well. These are all going to have different implications in terms of how we underwrite the documentation we request. So really having a handle, you're not just requesting $800,000, for example, right? You're actually, if you break that down, you're actually requesting, it could be, 200,000 for payroll, 150 for material costs, and understanding what that breakdown is and who the vendors are and where the payments need to go. That's really important information. So getting in front of that, making sure that that information is readily available, that's crucial. Again, it allows us to underwrite more more swiftly, quickly, get you fast answers, approve draws more quickly, and ultimately move the contract forward and allow you to move towards success, positive CPARS rating, higher bonding capacity, whatever it might be. So I do want to stress one thing about so when contractors get squeezed, they sometimes look for the fastest money available, and that could be, fintech financing where there could be daily sweeps, really high cost lines. And I think the reasoning can be rational in the moment, right? If you can get financing in days, yes, it might be expensive, but if you compare that against the alternative of potentially having a contract terminated for default, it might be the best option that that someone thinks they have at that moment. A lot of people will take those funds in those cases. We want to underscore there's a couple of things that happen in that case, though. First, the costs are going to eat the margin on the very contract that it's funding, right? So that's a problem. And then it actually will exacerbate the shortfall that is going to come up next. So it's something you can see coming, but it seems like it often comes as a surprise. I think, folks are so fixated on just solving the next problem in front of them. Sometimes it's easy to forget that that could actually cause the problem you're going to face after that, and tomorrow or in a week or two. And so to the extent that you're able to anticipate some of these and learn from others' experiences, I think that can help avoid, getting into similar traps, which we've seen a lot. So, we get it. I think the emergency money, whatever you want to call it, it can make sense in the moment, but we often see it actively block the affordable money from happening later. So, being able to buy some time, or even just having a conversation with the contracting officer. I've seen cases where the government can be very understanding. Obviously, it's a judgment call. I wouldn't recommend people do this blindly. But being able to buy some time can potentially be the difference between having enough time to get something sustainable and affordable in place versus making the problem worse, even if you just forestall the issue for another couple of weeks or even a couple of months. So that's something else I wanted to add. All right, let's go to the next slide. So I think the point here that we want to cover is why should you care about paperwork? And the answer I would offer is the reason is because every one of these parties you see here, they're making a speed and price decision about you based on what you can produce and how fast. And so, to say it plainly, this is essentially the document request list. So, it's not really a best practice in the abstract. These are the actual documents that you're going to need to get these critical elements in place, which allow you to actually successfully perform and perform in a compliant way the work that you've been awarded, whether you're a prime or sub, whatever the case might be. So for lenders, I think this is the part a lot of contractors sometimes get wrong. For a contract-based facility like what we offer, the financials are essentially confirmatory. And what I mean by that is it's not necessarily the basis of approval, but they establish that you can perform that there's if there is a liquidity dip, that's going to show whether it's reversing or not. And negative book equity on a fast scaling contractor is often expected. I wouldn't say it's an automatic non-starter, and it's not necessarily disqualifying. But I will say a lot of emerging contractors, they might not apply because they assume their balance sheet disqualifies them. But the job cost report by contract and the AR aging is actually going to tell us a lot more than the equity line does. And I think some of this just ties into the idea that more traditional financing firms and banks in particular, they're backwards looking. We like to describe ourselves as forward looking, insofar as looking at your contract backlog, looking at how much remaining obligated but unbilled dollars there are in that backlog, and then using that as a basis for lending. That's not the only thing we look at, but that's really the crux of it, and the key driver for us. Okay, so sureties typically comes up for folks in the construction space, but they're going to underwrite your discipline as much as your balance sheet, right? They're basically looking at the risk of you not being able to perform the work and them being forced to step in and take on that performance risk. And so for them, the backlog schedule, the WIP, it's going to tell them whether you know where you stand, how clean your records are, and your ability to show where things stand is going to directly impact their perception in terms of how confident they are in your ability to perform. Looking at CPARs, looking at documented policies in place. I think for anyone who has worked with a surety, this should be familiar, but that's their angle. Partners and primes, I'd say paperwork quality can be a competitive differentiator in teaming decisions. Primes remember which subs slowed them down versus which ones were ready to go and which ones were easy to work with, knew what they were doing, didn't need a ton of handholding. There is a distinction here with like a prime you're working with versus like if you're in a mentor protege relationship where there's almost an expectation that you're going to be a little bit less polished or less less experienced by default. But putting aside a mentor protege scenario, these are real factors that come up that will potentially impact your ability to work together with a prime in the future. So lastly, internally, things like a rolling forecast, a modification log, keeping that tied in with your contract backlog, these all exist so you can make faster decisions, and everyone else is going to be a secondary beneficiary to that. And so, needless to say, I mean, having a lot of what we're talking about here isn't only going to benefit the parties you see listed here. It's beneficial to you. So, lastly, I would say a contractor who produces the package or a package, if you just go through this list, the vendor who can produce this in 48 hours is going to get priced very differently, likely, because there'll be other things that, how long it takes someone to produce this stuff. It's more likely if it takes someone 2 weeks to produce this information that they're probably going to have other things that stand out as risk factors. So my point here is the vendor who can turn this stuff around in a day or two, they're likely going to get different pricing compared to the one who takes for the better part of 3 weeks. And so the speed of that diligence is itself somewhat of a term that ties into what you might get offered, whether it's by us or another lender. So really being organized, it can literally be worth basis points in terms of pricing. And I don't know if many people have thought of it in that way. So next slide, please. Okay, so I think one of the more common things we do run into is contractors or vendors who don't necessarily go after larger opportunities because they realize that they don't want, it's sort of a perverse chicken and an egg dilemma where they don't want to win a contract. I mean, that makes sense. You don't want to win a contract you don't feel confidently about being able to perform. And I think that makes sense. No one wants to win work and then have a contract terminated for default and then deal with the fallout from that. But that's also a very perverse situation insofar as, the point of most for-profit businesses and small businesses, it's to grow. It's to create more jobs, create a positive impact in the communities you serve and the stakeholders of that business, be it the employees, the families of the employees, obviously, the owners, the charities that they support, whatever it is. There's a whole chain of stakeholders here, but the whole point is to grow and to improve and increase that scale and impact, and not going after work that allows you to do that because you're not confident in your ability to be able to rise to that occasion and scale and meet the requirements of the job. That's a really lousy situation to be in. So I think part of getting out of that trap or getting out of that scenario, trying to grow beyond that, part of the first step is really understanding what can you do, like what is the limit of the current business in terms of your scale, your reach, your ability to access the capital you need to mobilize on a contract. And so really understanding that number is a critical starting point, because that allows you to then work backwards from where you are today and what needs to change, what are the constraints that you have to address to be able to turn that corner. So either way, like if a vendor is or is not doing this, the market is going to be providing you answers to these questions in the first place, whether you like it or not. So having some kind of visibility into your cash over the next several months is really important. It sounds obvious, I know, but some folks may or may not be surprised to see how often this is not done. A lot of vendors just are not doing this, but we think best practice is having a 13-week rolling forecast. Use the bank balance, from the previous month, and if you're starting today, or if you have a CPA, they should be able to help you with this. But if it's not something you're doing, we recommend you start as soon as you can. And again, this is very different than just like looking at your bank balance every day. Having a forecast requires a little bit more foresight insofar as you're looking at what invoices are outstanding, what still has yet to be billed but will be billed in the next few months, and what's the turnaround time and processing time on those invoices. There's everything on the expense side. So yes, it's important to look at the bank balance, but that's a very incomplete part of what I'm describing here in terms of having a true rolling cash forecast. Needless to say, one tells you where you were and the other is telling you where you're going, and that that's a critical distinction. All right, so documentation discipline. We really covered that already, but 5 business days every month. Consistency is always going to beat sophistication. When I say 5 business days, having the documents available, having the reports available in a short time frame is what we're getting at here. So again, if it's taking you, weeks and weeks to build this stuff, that's probably an indication that the process is broken or needs to be designed and improved. Bonding capacity, talked a little bit about that, but generally, good rule of thumb is working capital is typically going to be at least 10% of a contract. So, the backlog often is no more than 10x working capital. These are simple ratios you can check today. So it's a good way of just estimating even if you don't have a consistent process in place already. It's a good way of estimating, what your working capital needs need to be, or what you should be solving for in terms of how you think about access to capital. And the last point here in terms of capital access, we talked about this on one of the previous pages, but really making sure you're answering the question around if the funding you're seeking, if the amount of capital that you're seeking really meets the needs you have today, and also balancing that against what is in your pipeline and what might turn into a contract and a greater need tomorrow. And so, constantly looking at that, evaluating it, being prepared to seek that financing proactively, even if it's not something you need today. There's nothing against the rules from talking to a lender and getting ready to apply, or seeing if they could even take information from you now, so that if and when you win that contract and want to see the additional documentation, you can start those conversations now. You don't have to necessarily wait to start the conversation until after you've won the award, or you've received notice you've been down selected. So I would always encourage everyone to start early, have those conversations ahead of time, and not wait until you're in reactivity mode, when you're going to have less time and feel more under the gun to find something for being able to mobilize. The last thing I'll say here is readiness isn't size. So in other words, plenty of $3 million per year contractors are more ready than 15 million per year contractors. It's really a question of whether the infrastructure is there to be able to prepare these documents, have those processes to generate the reports that you need to have that visibility. That's what matters here. And does it mean that if you're larger, you've done that? Not necessarily. We've seen a lot of small businesses proverbially catch the car, and they did their best, but just by virtue of winning a larger contract doesn't mean you're necessarily in the best position to qualify or get access to capital if you don't have this documentation and the processes that underlie having that documentation requires. So we've got one more slide, and then we'll wrap up here. So I would encourage everyone to, when you're reading through this slide, think about this as more of a maturity curve. This isn't a judgment. We meet folks where they are, but that doesn't mean that there aren't opportunities for improvement. And that's really our goal in talking through a lot of what you've heard today. It's to share what we've seen in the marketplace, what we've seen work, and what we've seen contractors who are able to get approved for financing and grow successfully. And it's equally important to talk through some of the more unsavory instances where we can help someone, they're not able to turn around documents that we're asking for, the reports they're providing aren't really answering the questions we're asking. Use these data points as cautionary tales, because I think every failure or rejection, instance of rejection, denial, not winning award, I think all of those have value, and it's only really a failure if you're not learning from that. So take that to heart. And so what I mean by that, everyone's going to start in the left side of the column, whatever example or analogy you want to use. Nobody's launching with a 13-week forecast and a post-award checklist. A lot of newcomers to the industry, that's not normal. And usually, you need work and expenses and revenue to be able to start those things. So, I don't want this to come off as intimidating to folks if they're not doing this currently. but take it as a call to action and put it on your roadmap. And however it is you run the business strategically and improve, and add goals and add things to your roadmap. Put that on there if it's not something you're doing today. Size the capital to the backlog. We talked about it earlier, but that's a really critical piece. Really having an understanding of what your needs are as they relate to your contract backlog, right? This is the point about making distinctions between your potential total award, the ceiling amount, the timing between periods of performance, option periods and option items, etc. So really having an idea and being able to get your arms around what your needs are and how that ties to your actual contract backlog. I would say not one of the 5 habits you see listed here requires more capital and more headcount. So these are things that most companies should be able to start doing today if they wanted to. They require deciding once and then repeating and executing and having the discipline to do that. And that genuinely is available to a company of any size today. Some contractors, I would say, run in different through varying degrees of high and low discipline. So you don't need capital to do this. I mean, whatever the timing is here, even having a 4 or 6 or 8 week rolling cash forecast is going to be better than 13. So, I think also making the point that it's not all or nothing, having a report that exists and is imperfect is better than nothing. The purpose of this exercise is to know which situation you're in. And so don't let, someone else's deadline decide this for you. This is all about being proactive and preparing in advance. And if you do ultimately have a gap for cash flow, that's what we've built to address, which I mentioned. All right, last slide. So if you want to talk more about your circumstances, if you have questions that you want to work through with us, by all means, if you have general questions, please submit them. I think Madison had posted a note here to encourage folks to ask questions. But yeah, we think that it's really powerful to have the stress of cash flow feel solved and then be empowered to go after larger contracts. That's really what we've designed the product that we've alluded to today to be able to do. It's designed to allow vendors to be able to do that. And so if anyone wants to learn more, please reach out. You've got our contact information here. But with that, I will stop. Happy to answer questions if folks have them. And again, just want to thank everyone for taking the time to join today, or if you're watching a recording of this, thank you for stopping by.
Thanks, Eric. We do have a few questions. First off, the 60 to 90-day exposure window, does that change much by agency, or is it pretty consistent again across all agencies?
It definitely changes by agency, and it even changes within an agency from contract to contract. I think the point of having these ranges is, we of course aren't going to go through like case by case examples for folks. And so, there are contracts out there where the payment processing is so fast that for that contract for a given vendor, they effectively don't even have a need for financing or capital, because they're a lot, whether it's a combination of fast invoice processing with favorable payment terms with vendors, they're able to effectively float that the obligation with when they're going to get paid. But yeah, it's absolutely variable from agency to agency and contract to contract, vendor to vendor. So we're painting with broad brushstrokes here, but the thing I would say is this is directionally accurate, and these are the most common ranges that we're seeing. Obviously, there's going to be exceptions to that.
Great. Kind of along the same track, for a newer contractor that's never tracked these types of things before, is a spreadsheet really enough, or do they eventually need to like move into software that can track this?
Well, at some point, you almost certainly will have to graduate to software insofar as having, if certain contracts are awarded, if they're large enough, if they're sophisticated enough, if they're sensitive, if the nature of the work is sensitive enough, you might be required to have certain software, unless you like custom built it yourself and then had it, rated. And but there's a number of varying regulatory requirements and things like DCAA compliance and being, having audit readiness in place. Like there are cases where you effectively have to sign up and purchase some kind of software that allows you to meet the requirements that you're going to be held accountable against for a certain contract or a certain compliance, or just certain rule regimes that are in place. Other examples that tie into this are going to be CMMC compliance. Again, if you're subject to CAC, like cost accounting standards, there's a number of things. While they're not necessarily common for smaller dollar awards for small sized vendors or contractors, it can come into play. And every large business out there who's not small anymore, at some point, they didn't go from zero, not existing to large overnight or instantaneously. So they were small at some point, and while they might have very sophisticated systems in place today, once upon a time they didn't. And so I think everyone just needs to be aware of the potential there. So yeah, good question though.
All right, I think this is the last question we'll have time for. What does Alent and Excalibur GovCon actually look for when evaluating whether they're going to finance a contractor?
I would say two things to answer the question. One, what is your remaining unbilled obligated dollars of prime contract spend, prime contract dollars? So we would look at your backlog. Doesn't matter if you are a services vendor, a services contractor, if you're primarily product, it's the same in both cases. We're looking at how much have you been awarded, what have you been paid, and what's remaining or unbilled. And I want to stress it's the unbilled portion of obligated dollars. So in other words, it isn't playing a role in how much we would be willing to lend someone, how much they have in terms of unexercised option periods or items. We're looking at like the active periods of performance. So that's the first thing. And then the second thing would be performance competence. So how comfortable can we get that you're going to do what you've been contracted to do successfully? So we look at that using a lot of different things, but we'll ask for CPARS reports. We will look to see what's out there in terms of the public record. If we're seeing many terminations for default, that's probably not going to give us, a warm and fuzzy feeling. But those are the two. I'm obviously oversimplifying here, but those are the two primary drivers of us first making sure there's dollars to lend against, and number two, being confident that you're going to deliver the work or the product that you've been contracted to perform or deliver. And if we can get comfortable with both of those, if there's enough, if the first one's relatively simple, it's essentially a math problem. The second one is a little bit more qualitative. It's both quantitative and qualitative. But if I were to boil it down to those two things, I think that's the essence of it.
Great. Thank you, Eric. If anyone didn't get your question answered, please reach out to us. You can reach us at info@linkcapital.com. You can call us at the phone number on your screen. You can also go to the website and enter your UEI and get pre-qualified for the amount that you would receive from us. So if you have any further questions, please reach out to us. We appreciate Eric and Josh being here today, and let us know if you have any questions. We'd love to hear from you.
Thanks, everyone.